I know that many of you, if you're like me, you wait every week to get the gas storage report or get the oil inventory report and some of the other reports and forecasts that the EIA publishes each week. And we use those, of course, in developing our strategic plans and in making daily decisions. Today, we're very fortunate, of course, to have with us the administrator of the EIA as our post-luncheon speaker. Adam Szymanski was sworn in on, if he was born on June 4, 2012, it'd be an interesting dialogue here. He was actually sworn in on June 4, 2012 as the 8th administrator of the, yeah, there we go, all right, of the U.S. Energy Information Administration, or the EIA, as most of us know it. And that's, of course, the agency that is responsible for collecting and analyzing and distributing energy information and data and energy reports to the public. From March of 2012 to May of 2012, while he was awaiting confirmation as the EIA administrator, he served as Senior Director for Energy and Environment on the staff of the National Security Council. Before his service in Washington from 2005 until March of 2012, he was the Chief Energy Economist for Deutsche Bank, where he worked with the bank's global research and trading units and forecasted energy market trends. And probably many of you remember seeing some of his forecasts and reports back from his days as an energy economist at Deutsche Bank. He's written on a variety of topics, including energy economics, climate change, geopolitics, and commodity prices. He's a much sought-after speaker, and we were very fortunate to have Mr. Szymanski as our keynote speaker. I think, Adam, it was about 4 years ago, I think, maybe our first symposium. Very well received, great feedback, and he just does a fantastic job. So we're very fortunate to have him here with us today, and if you'll join me in welcoming Adam Szymanski.
Well, thanks very much to everybody that's been working on this, Bruce and Jay, everybody. I really appreciate that. It's great hospitality here. And what I'm going to do is I'm going to talk a little bit about forecasting in general. And then I'll make some forecasts. And then we might talk a little bit about job advice. I know there's a bunch of students here. And we got going on this actually at the lunch table. And there's a lot of people here who have been very successful in their careers. And they actually have some pretty interesting ideas about, what might help you out. So now let me talk a little bit about EIA. EIA is one of 14 major federal statistical agencies. Now the big one everybody's heard of is census. They count people. Well, we count energy. We have kind of three things that we try to follow. We're comprehensive data that covers all of the fuels. We try to be unbiased in our analysis, and we have a certain amount of independence. Even though we're at the Department of Energy, EIA's reports are not reviewed by anybody other than me. I'm the last person that signs the reports. They don't go to the secretary. They don't go to the White House. They don't go up to the appropriations committees or the energy committees up on the Hill, and we value that. And we try to inform the policy debate. We're not a policy agency. So now about forecasting. The first forecast I'm going to make today has to do with the Final Four. Now, my alma mater, Cornell, was never in. A couple of the teams in the Washington area, like Maryland and Georgetown, Villanova took Georgetown down. So I feel like I'm unbiased now because I no longer have a dog in the fight. So my unbiased prediction is that the victor will be sooner rather than the latter. All right. Now we're gonna start off with I call this the old man's oil forecasting, because when I was a young man, I thought I could forecast oil prices. Now that I have gray hair and no hair, I'm a little more cautious, and we'll talk about that in a bit too. EIA expects that West Texas Intermediate WTI oil prices are going to remain low compared to recent history. We have a point forecast. It's $40 a barrel for next year. Keep in mind that 2 months ago, we thought next year would be $50 a barrel. All right, so the forecast changed. The confidence band on our forecast is very wide, and I want to explain that a little bit. And I'm delighted that EIA is working with some of the people here in Oklahoma to work on financial markets and energy issues, including Chitru Fernando. I think Chitru is here somewhere up there, and Scott Lynn. Now, those gentlemen can help you out. You can go ask them questions afterwards. What is the Black-Scholes algorithm? Who's heard of Black-Scholes? Anybody here heard of Black-Scholes? This is great. This is a business school. Black-Scholes was, actually the Nobel Prize was awarded for the people that figured out Black-Scholes back in the mid-1970s. And the idea was equities or stock markets have been around for hundreds of years, and people kind of knew how to value those. Cash flow, stream of dividends, price-earnings ratios. Same thing with the bond markets. They've been around for a very long time, but the options markets, that was different. And Black-Scholes was designed to use volatility in the options market to predict prices, because people thought that the prices in the options market might be inefficient and they could make some money if they actually knew what the real value was around those prices. So EIA looked at that and we said, that's kind of an interesting idea. Well, I wonder if we could run that backwards, sort of like a Scholes-Black algorithm. And what we wanted to say was, why don't we just assume that the futures prices for WTI are accurate, that that's as good as anybody knows, and let's run that algorithm backward and see what that implies about volatility in the front end. How wide is the range on the prices that are being shown in the options market? So now here's what I can tell you. So we do that, and we do it every month, and you can get it on our website. We can say with a 95% confidence level that between now and the end of 2017, that WTI oil prices are going to be somewhere between $20 and $100 a barrel. Now, you say, well, that's pretty, do you get paid for that? Like, Adam, how much are we spending on you? President David Boren here, who used to be a senator, might like to hear about that. So, well, now this is serious. This is actually valuable information. So there was actually a question at the end of that last panel about the speculative activity and in the futures market. So let's think about that for a second. Who is in that market? Well, producers are. We heard about some of the producers using the futures market to hedge forward so that they could get some cash now to do some drilling, right? So then we have speculators that are in there, but banks and others, but we have refiners, you got airline companies. There used to be articles written all the time about Southwest and how they used the futures market to try to hedge their jet fuel prices. Farmer, there's a lot of people, trucking companies do this. So you might say, listen, all of that money and all of that smarts is basically telling you that they don't have the foggiest idea. So here's what I take away from that. Anybody that actually really truly needs to know what the price of oil is going to be ought to probably be in a different business. Or they ought to have Plan B. Now, who needs Plan B? State of Oklahoma for tax collection, state of Alaska, state of Louisiana, Texas, Nigeria, Mexico, right? And oil companies, right? See, there's a lot of people that depend on this, and I'm just telling you that I've been trying this, and a lot of people claim that I was one of the best oil forecasters that they ever met, and I kind of look back, I kind of go, ooh, like, I wonder how I'm going to explain that to St. Peter. Okay. Now, I'm not a super religious guy, but there's something about oil that I've seen ups and downs in my career, which started in the early 70s. I've seen 6 big increases in prices and 7 big decreases. And if you divide the number of years that I've been doing this, what you'll find is something that is illustrated in Genesis chapter 41. 7 lean years and 7 fat. Okay, now, I'm going to conclude on a happy note with that particular thing, and then I'm going to go faster. The happy note is, I think this is cyclical. I don't think oil prices are going to be stuck at $35 or $40 forever. This ain't my first rodeo. Why does oil go back up again? Listen, the economists, I don't have 2 rulers here, but the economic textbooks talk about supply and demand elasticity, and all of the illustrations are these kind of flat lines that say a little change in price gives you a little, enough change in supply or demand. What it looks like in oil is like this. It takes a huge change in price, up and down, to get you the changes in supply and demand that rebalance the market when something goes wrong. That's why I think we get these cycles. And getting out of the cycles, shale was supposed to be one of the ways out of that cycle, but on the downside, it didn't work nearly as well as the Saudis and others thought it might. All right, now I want to talk about forecasting. Would you like to be a super forecaster? I just read 2 books, one by Nate Silver called The Signal and the Noise, another one by Philip Tetlock and Dan Gardner called Super Forecasting, The Art and Science of Prediction. Now, what both Tetlock, Gardner, and Silver talk about a lot is a couple of animals, hedgehogs and foxes. Now, let me explain that. Hedgehogs strive to know everything there is to know about a small set of problems. Where are the grubs? How do I dig them out? Foxes are much more multidisciplinary and adaptable and self-critical. They'll try a lot of things. They'll go after a lot of food sources. Hedgehogs make great, fantastic TV personalities. They typically have huge, big ideas, and they really sell them. Foxes are a little bit more cautious. In baseball, foxes walk and get singles a lot, and hedgehogs thrill fans with home runs. But they strike out a lot, too. It turns out, based on the work, and it was pretty serious statistical work that Tetlock and others did, is foxes make better forecasters. So what's a portrait of a super forecaster? Cautious, reality is complex. There are so many things going on in the oil market that trying to figure that out is really hard. There are geopolitical issues. What about Venezuela? What about Saudi Arabia? There are economic issues. If the price of gasoline goes down to $2 a gallon, how much more is going to be used than when it was at $3.50 or $4 a gallon? Lots of political things. We heard some of that in the panel this morning too. Political uncertainties, even here in the United States. What about hydraulic fracturing? There's several of the presidential candidates that are talking about not being too friendly to fracking, but that's half of our oil and gas production is coming through hydraulic fracturing. Intelligent, but not a savant. Curious, enjoy puzzles, like numbers, pragmatic, don't have an agenda. That kind of fits EIA. Try to stay out of the agenda business and stick with the facts. Be flexible, focus, maybe don't focus on a single idea as the answer to everything. In Wall Street, and I spent a lot of my time there, there was an adage, don't fall in love with your stocks. If you're a trader, don't fall in love with your trade. If the facts change your mind and move on. I actually had that lesson. One of the biggest financial, wrong things that I did is General Motors stock fell from 45 to 15. I looked at what they were doing with the Volt and electric vehicles, and I said, I think that's kind of where we're going in the future. I like that. Surely that stock price can't go any lower than having fallen from 45 to 15. I rode that puppy all the way down to $2. So then I went to the guys, I was at Deutsche Bank at the time. I went to the Houston office and I talked to our gas traders down there. I said, what mistake did I make? They said, you fell in love with your idea. And I said, yeah, I did. I thought I was right. I wasn't going to give up. I was right. And I said, well, what do you guys do? And they said, well, always have more than one idea. And and then set a cutoff point. Like if your idea goes down 15%, get out and go to your second best idea. And you're smart. Your second best idea, might be a lot better. Have a third idea. And I think that was a very valuable lesson. Now I want to just talk about the oil markets in general for a bit, and then we'll just do Q&A. EIA believes that supply in the world markets is still higher than demand, so inventories are still building, but the gap is closing, and inventories are not building at as high a rate now as they were a little while ago. In our numbers, this gap is not going to close until further out into 2017. So in the physical markets, it could take until the end of 2017 for supply and demand on a global basis to balance. Now, my experience tells me that at least 6 months before that event happens, the financial markets will start to reflect the fact that the physical markets are going to balance out. And what that says to me is that probably sometime as we move out into early next year, we're going to begin to see some positive movement in oil prices, even beyond where we are now, which, as indicated in the last panel, might have been just a bounce up from truly unsustainable numbers that we were at earlier. On the supply side, one of the biggest issues in 2015 was not the growth in 800,000 barrels a day growth in North American production. So we still had average year from 2014 to average year 2015. Shale was still coming, and Canadian oil sands. But there was more OPEC production growth in 2015 than there was in North America. Mostly it was Saudi Arabia and Iraq. Now we still have, this year, we've got North American production falling by 500,000 barrels a day or so. But OPEC production could be up more than 1 million barrels a day. Iraq and Iran are growing, and maybe next year Iran alone could add some more. We'll have to see. I think Iraq is kind of beginning to tap out financially. I think Iran, it's going to take them a while. They'll have a quick bounce from the very low numbers under the sanctions, but whether Iran is going to be able to attract capital in the long run is a different story. But OPEC is still a really interesting issue, which makes for the interesting geopolitics that you read about. U.S. crude production, we believe, is now declining. In the 4 largest, shale fields, Eagle Ford and the Permian, the Niobrara, and the Bakken up in North Dakota, we see production falling off. We almost hit 10 million barrels a day. We were at 5 million barrels a day back in 2008. So there was a tremendous amount of growth there, and that was just the crude oil. There was, we're up to 3.5 million barrels a day of natural gas liquids. Rusty was saying, what is that? It's ethane, propane, and butane. There's a lot of that material around. It gets counted in barrels rather than in billions of cubic feet. And there's 1 million barrels a day of ethanol in the liquid system. There's 1 million barrels a day of refinery gain. Does everybody know what refinery gain is? So you put crude oil into a refinery, you put a barrel of crude oil into a refinery, and you get more than a barrel of products coming out the other end. And that sounds like it's almost defying physics, but you're going to go away, and you're never going to forget refinery gain. This is how it works. It's microwave popcorn. You put that thing in that's about that size in the microwave, and when it comes out, it's about that size because you've kind of expanded the popcorn to occupy more volume. And if you put heat on crude oil, in the refining process, you actually pop the molecules out in gasoline. So gasoline weighs less than crude oil for a barrel of it. And so that refinery gain in volume, if we were in France, we would be measuring tons. And I can assure you, a ton of crude in, you get less than a ton of products coming out. But that's not true in volume. So, there was a law that said we were going to move to the metric system about 30 or 40 years ago. It didn't happen. That reminds me, I forgot my opening line. I'm from Washington. I'm here to help you. Ooh. All right. Demand is probably going to be pretty steady at 1 million barrels a day of growth. We are at EIA seeing some deterioration in our economic forecasts for the non-OECD countries. So that includes China. People are getting nervous about China. I think that's one of the issues behind the drop in oil prices. There are a lot of financial issues out there. We have 2015 data that oil companies wrote down almost $200 billion in assets last year. It's probably going to be worse this year. What's going on in a number of different things. Long-term debt to equity ratios are rising. Return on equity is falling. Production, which went up in 2015, is definitely going to be coming down in 2016. CapEx is collapsing. CapEx in 2015 was down 30% from 2014, and I don't think it's going to be any better in 2016. So that actually raises an interesting question, and some people miss this. So I'm going to try to make this argument and see if you get it. If the price of oil goes back up and we get $50 or $60 oil, Scott Sheffield said that at $60 he thought he could be back in business again with the shale. Does that mean that we're going to cap because we can get the growth? Let's just say global demand is 1 million barrels a day. Heck, we were doing 1 million barrels a day between, from 2012 to 13 to 14, even into 15, we were getting that 1 million barrels a day of growth. So does that mean shale absorbs all of the growth in demand for petroleum? Well, you could say that, but hold on a second. Shale at 5 million barrels a day, when the crude oil market globally is, rough numbers, 80 million barrels a day. It's not 95, that's demand, but that includes all those other things that we were talking about, the NGLs and the refining gain and all the rest of that, ethanol and so on. So what about that 80% of that old kind of non-shale kind of oil? How much CapEx is required to maintain that? What does it decline at? What's the decline rate if you don't invest in non-shale petroleum? And I think the answer might be, again, rough guess, 5% a year. 5% of 80 million is, do the math, 4 million barrels a day. So maybe it's only half of that, 2 million barrels a day. So shale meets the demand growth of 1 million barrels a day. Who's going to meet the 2 million barrels a day of growth that you need to kind of balance the whole system? It's like, this could be really tricky. This is why I'm going to go back to Genesis and say 7 lean and 7 fat. We could have the lean and you don't get the CapEx, and something is going to happen, and that something could be just the economics of it, or it might be a geopolitical issue. And if I had to pick a geopolitical problem, the country that I think actually is one of the most interesting to look at is Venezuela. 3 million barrels a day of production, 800,000 barrels a day of crude oil coming to the United States, Gulf Coast. It's that heavy sour crude that fills up the refinery kit down there. And big social problems, big economic problems, big problems. And I don't know, the Saudis might have some spare capacity, but they don't have 3 million barrels a day of spare capacity. So let's talk about renewables for just a second and cars. Can we solve this problem by having natural gas vehicles and electric vehicles and even gasoline electric hybrids and so on? EIA does long-term forecasts. There's about 250 million light-duty vehicles in the United States right now. We think that by 2040, that number will be up to something like 300 million. So you sell, I think Detroit is actually going to sell something like 17 million cars this year. It's total, so that includes some but you have retirements, and so the difference between the sales and the retirements gives you the growth number, so we'll have some growth. We think that gasoline-only vehicles kind of hang on to their market share, and that a lot of the growth that we're going to get is going to be in electric vehicles and natural gas. But think about it, if most of the so there's about 225 pure gasoline vehicles on the road, and even if you retire them, the replacements, we're getting a lot of SUVs that are gasoline only. This is not easy, right? Like even with the push to electric vehicles and natural gas vehicles, which probably made more sense when natural gas was lower and gasoline prices were higher, it's really hard to transition completely off of a gasoline fuel. I'm going to talk about the world for a second, world energy consumption. Right now, it's still dominated by oil. About a third of the world's total energy consumption is liquids, so mostly oil, crude oil. We actually think that, and let's just call that 90 million barrels a day in 2014, 2013, which is the base year for our international outlook, 2012 actually. It could be 120 million barrels actually in the year 2040, and it might be a smaller percentage of the share. So oil's share could be going down, but we still see a lot of oil being used globally, and most of that in transportation. It's, as I said, even in the United States, it's hard to get it out of the auto fleet, and a lot of other countries, diesel fuel consumption is going to grow pretty rapidly as populations and economic growth calls for hauling goods around. Natural gas is going to grow very strongly, we believe, on a global basis, and it'll be the second largest fuel on a global basis by 2040. Coal is the second largest now. So we see coal going up out to about 2030, but then flattening. And just about at the time it flattens in 2030, natural gas is still going up, and so there'll be more natural gas used than coal after 2030. But there's still going to be a lot of coal being used. India and China, growth in coal consumption is likely to be very strong. Renewables, fastest growing of any of the fuels. It's going to go from 12% on a global basis to 16%. Now, it's huge growth in percentage terms, but the share that it represents by the time you get to 2040 is still fairly small. Nuclear will grow, probably because of what China is doing, but it'll still be a relatively small portion of the output. Now let's get to the U.S. and talk about this in U.S. terms. Let's talk about in terms of electricity. U.S. electric net generation right now running somewhere around 4 trillion kilowatt hours a year. We think that'll be 5 trillion kilowatt hours in 2040. Gas-fired electricity we think will be up by almost a half into 2040. Renewables doubles. But it goes from 13% to 26%. Gas is already at about 26, 27%, and will be 40% by 2040, and that's with the Clean Power Plan. Nuclear kind of flat in total kilowatts, but its percentage slightly down, and coal gets hit. So under the Clean Power Plan, there's going to be less coal, and it's going to fall from the high 30s percentages in 2014 to the high teens. So let's just say it's going to go from 40% to 20%. So coal goes down by quite a bit, but there's still a lot of coal being used to generate electricity even in the year 2040. Why? Because it's pretty competitive, and a lot of it can be done fairly cleanly. Carbon dioxide, well, I don't know. I mean, there is some experimentation going on with capture and sequestration. So far, it's been very expensive, and so we'll see. So I guess I kind of fall into the same thing that you heard earlier, which says the end of fossil fuels is not on the horizon. If the environmental consequences of burning those fossil fuels, if we are going to treat those seriously, then we're going to have to find better technology or techniques than we currently have in order to deal with it. There are 1 billion people that don't have electricity. I've been to the slums in Mumbai, and I'll tell you, those people need electricity. They need electric lights. They need to cook with propane. They need fuels just on a kind of a human basis, right? I mean, we're talking about pretty serious poverty. And I want to kind of end on, I said I was going to give some advice, but I want to talk a little bit about, before I do that, last comment, another book that I've been reading. I think I actually have a copy of it here. And this makes for a good show and tell. This book is a risk breaker. This is Robert Gordon, The Rise and Fall of American Growth. And Robert Gordon's, this book was cited as on the must-read list by 2 of the senior executives at CERAWeek down in Houston a month or so ago. Gordon's thesis is that the kind of economic growth we had in the United States between he says a wide range is 1870 to 1970, a narrower range is from 1900 into the 1940s or 50s, is going to be hard to repeat. And one of the interesting things that he says is the reason it's going to be hard to repeat is because of so many things that we did during that period to make life better for everybody. And he's got his list is kind of, to me, it was very interesting. I saw him at a meeting, conference in New York, and I actually asked him a question, or I pointed out to him his list. He calls it he calls it total factor productivity. It's kind of like labor and capital productivity. What is it that creates growth? And he said what we had in that time period was electrification. We got electricity. We got the gasoline engine. Everybody's heard the story. I mean, and from all of the stuff, I mean, one of the things that's in this book is story after story of how much horse poop there was in our major cities until they figured out the gasoline engine and we started driving cars around instead of hauling everything around by horse-drawn wagons and buggies. And it was like a serious environmental problem and health problem. Telephonics, so telegraph, telephone, everything that we're doing there, even the internet, water and sewer, infant mortality dropped from 200 per 1,000. People would have 5 kids and 1 or 2 of them would die. That hardly happens anymore. And why was that? Water and sewer. Well, does that have to do with energy? Yes, it does have to do with energy, because what we figured out was how to pump water and how to get rid of the sewage, and that required energy. Pharma and medical technology. A lot of pharmaceuticals are really, it's kind of another form of refining. I mean, it's petrochemicals in some broad way. And then he talked, interestingly, about the workplace and the home. And I have to laugh about this. How many are engineers here? I think there's a lot of engineers. HVAC, heating, ventilation, and air conditioning, right? So when we could heat and cool homes and offices, productivity went up. Houston would not exist, actually, if you didn't have air conditioning. I mean, think about it. I mean, I think there's some truth to that. I think, and what I said to Gordon, I said, Professor Gordon, I said, arguably, at least half of these things that you're talking about were energy related. I mean, certainly electricity and the gasoline engine, and then I would say I would give at least partial credit for some of the others. I mean, this is actually really pretty remarkable. Okay, so I'm done, except that I want to give you unsolicited advice, you students here. I think you should be hedgehogs early in your career. Become an expert in something. I'm not sure it really matters a whole lot what that is. Just become an expert in something and then see what happens, right? And there's people here that I think are going to agree with me on that if we get a chance to. A lot of my career happened by accident. I got into energy because the guy, I was doing environmental stuff, air and water pollution, as a civil engineer, looking at that in the early 1970s, and the guy sitting next to me was doing energy, and he left because he got his salary doubled working for a Wall Street firm doing energy. And I looked at what happened to him, and I asked my boss if I could have his job. and the boss said, well, what are we going to do about your job? So I very bravely, calmly, and boldly said, I could do both of those jobs. My boss liked that attitude. I did that for a while, and then I moved on. Read a lot. You got to learn to write. Listen, I was an engineer, and I think I got better marks in writing than I did in some of my math classes, you know. And it doesn't help to be a really good technician and not be able to communicate that to the people around you. You got to learn to write. You got to learn to talk. You have to, I think, even if it's in small groups. So you got to learn to ask questions. Force yourself to ask questions. Listen and then ask questions. Volunteer. Biggest regret I have at going to Cornell is I was at a big university, Oklahoma, is just like that. There's a gazillion groups that you could join. And, you know, I did the American Society of Civil Engineers student chapter. I did that. But there were all kinds of other things. I actually was fluent in Spanish when I was in high school, and I kind of lost it in college because I was too busy doing engineering, and I regret that. Volunteer, join groups, travel if you can. One of the most amazing things to me in going around talking to college students is I'll often say, do you have a passport? You know, and it's amazing who's got a passport in here. Right, okay, so more than half, probably 2/3. So listen, students, Prague is a really interesting city, and they've got the best beer in the world. And it's really cheap to get there, right? You get a cheap Icelandic air flight to the UK, and then you can get to Prague really cheap. And why do I say go to Prague and drink beer? Because it's an international experience. It will teach you. You will learn more about America drinking beer in Prague than you will staying here in the United States. Trust me on that. Okay. Travel if you can and ask questions frequently. So now I'm hoping that there will be frequent questions. So who's got one? Students get the first chance. Who's a student that has a question? Come on, students. Dave.
Adam, thank you. Great advice. This is kind of a technical question about inventory.
A technical question about inventory.
Yeah, we get inventory numbers. We look at you. And
oil inventories.
Oil inventories, and we look at those numbers. And there's this thing about unaccounted barrels, which is, I think, an over-import against domestic demand. Is that a good
So we
description?
do weekly numbers that kind of do balances, input-output balances for oil. So we try to look at what we think production is, what refining runs are, what imports are, what exports are, what the changes in inventories are. And sometimes the numbers don't balance because you're measuring a lot of different things. And people, I guess rightly, maybe they should think about all of the stuff that's going into that. Look at these weekly numbers, and they get a little freaked out if the numbers don't quite balance. I'm pretty confident of most of the stuff that we're doing in the weekly statistics, except for the export numbers. So this is a funny thing, right? Like, if you were to say, make a list of regrets for EIA, not mine, but like what mistakes did EIA make? So back in the early part of the 2000s, we decided that we should. Natural gas prices spiked. They went up to $10. The Congress was all upset. They wanted us to have better data on what was happening with natural gas production and storage, that rather than monthly numbers that often have a 2-month lag to them, right? Like just today or tomorrow, we're going to publish monthly oil numbers, but they're for January. Now, the monthly numbers have a much better chance of being accurate than the weekly numbers just because of the nature of it. But the regret was we don't have, there is not enough money. The American taxpayer does not want us to do a census. That is to count everybody. You know, even that's now controversial. Should you literally knock on everybody's door to count every person? A lot of times we do sampling. And what we say is that we can do a cutoff sample if we can figure out how to get 90% of the production of natural gas, for example, then we can estimate the remaining 10% will have a pretty decent number, and it won't cost nearly as much as trying to do every, small independent producer. So, of course, back in 2002, when we dreamed up our monthly natural gas report, the 914 survey, we said, well, look, where does the gas come from? And the answer was Texas, Oklahoma, Louisiana, New Mexico, and Alaska. And if we just had 5 states, we'd have 90% of the production. Well, we didn't think about putting Pennsylvania on the list. Now, Pennsylvania is producing 17 billion cubic feet a day out of the Marcellus, and we didn't have them in that. And you say, well, that's easy. Just put Pennsylvania on the dang list, right? There's something called the Paperwork Reduction Act that was designed to protect you as citizens, you as companies, from having every crazy federal bureaucrat wanting to know everything about you and your company. That is, do we really need to know how much gas is being produced in Pennsylvania or not? And so we have to go through a 2-year-long process of showing that we have a legitimate reason for wanting to do things. So I started this up when I got in there as EIA administrator 3.5 years ago, and we now are collecting data in Pennsylvania. Interestingly enough, and here this gives you an example of as a policymaker, you're always balancing things. There is never an absolutely perfectly clear answer to anything that I can tell. We said, could we put New York on the list? And we said the reason we want New York on the list is because the Marcellus Formation goes right under New York State. And if they ever decide to start drilling up there, we would want to have them there and not have to wait 3 years, to get permission. And OMB kind of said, well, how much are they producing now? Very little. And they said, well, so you're just going to put a burden on the state of New York and the people up there by asking them to report to you stuff that you don't really need. And if you need it 3 years from now, ask us. All right, I think that's probably legitimate. But that's, so back to your question about the inventory numbers, I'd be very skeptical about trying to draw a whole lot of conclusions from the weekly data. And I would much rather look at the monthly numbers. The export data we don't have. That's how I digressed. I have to give shorter answers, or I think we're already out of time. The answer to why we don't have very good export data is because 10 or 15 years ago, when we put in place all of our own surveys to measure imports, we were importing a lot of oil. And now we're not importing nearly as much crude oil, and we're exporting a lot of products, and now we're starting to export crude oil. And frankly, we just didn't think far enough ahead. It didn't occur to us that we should have our own survey on oil exports. So we're trying to get those numbers from Customs and Border Protection, and we actually have an agreement with them to begin to look at weekly data, and that's going to dramatically improve those numbers, and I think it'll reduce that kind of unknown number that falls into inventories and elsewhere. So let's do, I promise, if you ask a quick question, I promise to give a quick answer, and then I'll be at the discretion of the folks here as to how long we should go. Yes, sir.
Okay, I'll make this real quick. We've heard a lot about Saudi Arabia and
Right.
Russia and their production, but no one has mentioned the Canadian production. And I'm just wondering what their impact is on the world supply, and where do you see their break-even price at?
Yeah, I kind of have a feeling that countries in the developed world, like Canada, Australia, United States, UK, probably have similar break-evens. I mean, if the resource, in Canada, the resource base, they've got shale, they've got traditional oil, they've got oil sands. Is the break-even for oil sands the same as the break-even for shale? Probably not, because it involves more mining and pre-processing, cooking the shales and so on. But the Canadians are doing a lot of work now. In another 15 or 20 years, the bulk of Canadian production from the oil sands is going to be from underground wells, not surface mining. I think that the break-evens up there are, I think we're below break-evens in a lot of places right now. Not for every company, not for every prospect, but on average, $40 oil, I'm going to vote with Scott Sheffield and say, I don't think that's going to work. And even if at $50 or $60 we can do a lot of shale here, I'm not sure $50 or $60 oil is going to work for a lot of that 75 or 80 million barrels a day of traditional and oil sands and other things that are out there, deep water. So there may yet be a day of reckoning. So on the break-evens, and I do agree that they're coming down. One of the things that I think was horribly, horribly wrong with the peak oil thesis was they said prices and technology didn't matter. All you needed to know was how much oil was in the ground, and when you produced half of it, you were on the downside. And it turns out prices do really matter, and it turns out technology really, really matters. And knowing how much oil in the ground changes very dramatically with price and technology. So, just as a quick example of how the technology and fracking could change, when we first started doing fracking, they were fracking the entire length of the wellbore, and then somebody said, if we cut that up into segments, we could control the pressures much easier. So now we have multi-stage fracturing, and it's much more technologically better. I mean, you're getting more oil and gas out for less, for the same amount of effort. Well, now it turns out there's like this 80-20 rule. There's a lot of 80-20 rules. Like 20% of what I said was valuable, and the remaining 80%, all right. So, the last point on the 80-20 rule, 80% of the oil production is coming from 20% of the fracturing segments. And if some smart person at Schlumberger or Halliburton or one of the companies, some engineer, goes in and says, boss, I got an idea for how we can identify the 20% that are going to be the most productive before we frack them, they're going to go a long way, and we're going to reduce the cost structure. Last question.
I have a question in relation to an issue which was mentioned about the impact of margins and on futures prices, volatility, and things. So one of the issues which is engaging
margin requirements, high frequency trading, which wasn't mentioned but is another issue.
Yes, I mean, of course, my preference would be on high frequency trading because I'm working in that area. But my question right now is on position limits. So that's an issue which is engaging regulatory attention, enormous regulatory attention at this time. Whether the large number of hedgers who are currently not subject to position limits should be subject to position limits. Do you think that the regulatory attention and energy and enforcement, et cetera, is worth this issue?
Right. So that's a perfect question for me to make really short, because that's a policy question, and I'm going to stay out of the policy debate. People at the Commodities Future Trading Commission are working on that issue. There are people like Ed Morse who would be delighted to answer that question if you come down here and ask him after I thank you for your kind attention today and your hospitality here in Norman and the University of Oklahoma. Thank you.
Adam, thank you for coming back to Oklahoma again. And I don't know about you guys, but I got many takeaways from Adam's presentation as usual. And of course, probably the number one takeaway, I think maybe we still have some media left over here, would be the takeaway I hope to see in the paper tomorrow, and that is Adam Szymanski, administrator of the EIA, selects the Sooners to win the big dance. So thank you guys for coming again this year, and we hope to see you again next year. Thank you.